Let's find the link and start posting for everybody. See, now it's not giving me the link. What the hell? Oh, here it is. All right, took a second. All right, copy this link. Looks like there's some latency, but all right. I'm gonna go ahead and minimize that. I'm sending you the link now.
Okay.
We'll just wait for everybody to join in. Yeah, Facebook has been like giving us the worst problems ever.
Yeah.
Yeah, Joe was on the other night and it started like messing up or whatever. And it messed up for me the other day. It literally just cut me off. I'm wondering if they're using software that like detects, you know, like certain words.
Yeah.
And if you say Bitcoin or crypto or something and it's cutting you off. No, seriously, I started saying it a bunch and it just literally cut me off. It was like, your stream has been ended. And then Joe was doing it the other day and it cut him off.
That's so weird.
I'm wondering if they're doing it since they're like banning, you know, all this stuff from crypto or whatnot. So that could be a real issue for us in the future.
Well, hey, if they're cutting videos, I wonder what they're going to do with groups.
Yeah, so I know that's what scares me. And I'm thinking about making a group that basically doesn't have the word crypto in the title and sharing it with everybody. That way everybody can join that group and we just won't use it. I'll just put it admin only post.
Yeah.
And that way, in case they shut down CCT or 51% crew, we can just activate that and everybody in CCT and 51% crew already will be there. So we won't like, you know, we won't take such a hard hit.
No, that's a good idea.
But looks like 20 viewers are already on. So I guess if you're watching now, everybody, obviously you know who I am. Just give us a few minutes. We're going to let everybody get on here and then we'll get this started. So we're just going to basically talk for the next few minutes and, you know, nothing important. You want to grab a soda or something or whatever from the kitchen and come back and join us in 2-3 minutes and we'll be good to go. It looks like the viewer count's just like going up. So, but yeah, man, I just don't like the fact that they're doing that to everybody. We're going to have to create a group that's like secret or something.
Yeah.
But that way, you know, if they do get us, man, that would suck. You know, I mean, we got 14,000 people in the group and for them to shut that down is kind of messed up.
I don't think they'll go that far. That'd be pretty crazy. But I guess we'll see.
Well, they've obviously been doing, what they've been doing also is everybody can't see this, but obviously since I'm an admin, I have the admin control panel. And even when I post my own videos, they're flagging it for spam. They're like, oh, we flagged this for spam. And you go in there and it's like, please approve it. So they're making me approve my own videos. Does it make any sense?
Yeah.
So it's just ridiculous. And I'm keep saying they keep flagging all kinds of stuff that people are posting if it's like a link or whatever. And I'd say 85% of the time, it's just people trying to post something. It's not even like anything malicious or anything that they want to, you know, cause harm to the group or anything like to that nature. It's just they need to get their flagging right. So let me grab my MacBook charger. Looks like we got a bunch of people on here already. If you're on here or something, can somebody test the chat? Make sure that's working for us, one of our viewers. Anyone?
So it looks like the chat on YouTube, that's where it's actually apparent. The Hangout chat is just me and you, it looks like. But on YouTube,
okay.
But in YouTube, you can see the chat from other people.
All right. Well, let me flip over to that then, and I'm gonna try to like. Hopefully, I can mute this.
You could pop out the chat. Actually, that's what I'm gonna do. You could pop out the YouTube chat, so that way you've got the Hangouts video with me and you up, and then the chat.
I got it. All right, everybody's saying hi. Hi. What's up, Ron? Sweetie cakes. Yeah, Savin, they are listening to everything. Man, sorry, I missed all your guys' chats. Now I got to figure out how to pop this out because that's latency.
Yeah.
Actually, I'm going to do this.
I was able to pop it out. There's a button on the YouTube chat, the 3 little dots. You see it?
Yeah, I got it. Oh, pop out chat. Cool. All right, I got that out. Let me kill this because there's latency. Sorry, buddy, we're having a little bit of technical difficulty. I'm getting this down there. Don't worry. There we go. Now I got that on the side. Cool. We got our private chat. I can read what everybody's saying. It's working good. Nice clear stream. This is better than Facebook, actually. All right. Well, looks like we got our viewers on. Give them, if not, they can go back and watch this. So let's go ahead and get this started. Everybody obviously knows who I am, Todd, 51% crew. Tonight I have Andrew Gordon on here, and he was on our channel before, and we had a discussion on crypto taxes. Kind of a touchy subject here. And he contacted me. We're just doing a follow-up video, something kind of casual, but obviously we want to bring some information to the community, and that way they can make an educated decision how they want to handle all this. And obviously I'm not a lawyer, I'm not an accountant, so I'm going to more hand the floor over to Andrew because he is the professional here, and let him do his thing, explain this to us. So Andrew, welcome. Where do you want to start?
Well, thank you, Todd. I guess I'll first start maybe just by briefly introducing myself.
Absolutely.
I'm an attorney, also a CPA. I've been practicing in the crypto industry for probably about 4 or 5 years now, late 2013, early 2014. Back then, there was actually no guidance from the IRS on how crypto is taxed. And so we've been following the industry since then. And what I mainly focus my practice on is tax controversies. So IRS audits, criminal investigations, the serious tax stuff. So in that regard, we're able to see kind of where people make mistakes and how to avoid those types of mistakes so that you stay outside of the IRS's crosshairs, especially with regard to crypto. And I guess maybe even to quickly comment, a few things have changed since we last spoke. Todd,
I was going to ask you that. I figured that's why, So
yeah.
Bring us up to date. Tell us, what don't we do? I don't want anybody getting in trouble.
Sure. So some things haven't changed, right? Crypto remains taxable. It remains as property. Those types of things haven't changed. But one of the things that has is reporting to the IRS. When we first spoke, there was a lot of discussion about, well, how is the IRS even going to know about your crypto activity? And it doesn't need to be reported. Well, certainly it needs to be reported, but the question of how is the IRS going to find out has become more clear. In early January, Coinbase made an announcement saying that they were going to file Form 1099-K showing the total amount that goes in to people's accounts if it's over $20,000 and a few other thresholds. But Coinbase basically said, we're going to be telling the IRS all this information. And that now also puts a much stronger obligation on the taxpayers to have to not only report, but reconcile to the 1099-K to the information that Coinbase provided. So And it's not only Coinbase. Gemini, GDAX, U.S. exchanges are filing this form showing the total amount of deposits or purchases, the total amount of crypto going into the user's wallet.
Now, when you say going in as far as purchases, are you referring to, say I go in and I make a bank deposit or a credit card purchase or debit card purchase or however that, or actually taking my Bitcoins and sending it to one of their addresses? What can you define like deposit?
Yeah, and you know, I'm being vague because Coinbase is actually vague. The form that they're reporting is called a 1099-K. Yeah. This form is typically used by companies like credit card processors, PayPal, eBay, and it shows the total amount of processed transactions. Coinbase is showing either the total amount of transfers in from other wallets, because they can't distinguish other people versus your own personal wallet, versus purchases that you made of crypto with fiat, with U.S. currency. So all of these things are being considered when Coinbase or other companies are reporting on the 1099-K. So they haven't really provided great guidance. Unfortunately, the 1099-Ks we've seen too are very large numbers and don't necessarily show just purchases. Again, if you transferred from another wallet, someone transferred to you, those things would be reported too.
Okay. Well, see, that's a big issue though. I mean, that runs into the problem if, you know, that's almost running into like double, triple, and quadruple taxation if they're reporting, you know, if I want to send some Bitcoins over there and do something with it and trade, like, you know, and then, for example, say, you know, I bought them on Gemini and then I send them to GDAX. Now I'm getting double. And if you know, it's common for traders to move this from across multiple exchanges, especially with arbitrage. So
absolutely. Yeah.
You know, now we're running into 4 or 5 or 6 1099-Ks coming at you at once. You know, the next thing I know, you're like, this say you traded $100 million this year when it really wasn't.
Yeah, we actually had a client come to us, probably only had about $50,000 to $100,000 value of crypto. 1099-K showed over $1 million. And that was because she moved it all around, you know, out of Coinbase, back into Coinbase, to other wallets, back into Coinbase. And so this 1099-K amount is very high. Now, the good news is this isn't your taxable amount. This is just informing the IRS, this is the total that came in. And so, you know, the IRS isn't going to necessarily just tax you on that unless you don't report anything. If you don't report anything to the IRS, all they have is this total. So, you know, if you do the right thing and actually calculate your gains, report all that, no concerns, even though that 1099-K amount may be very high. Where really people are going to run into issues is when they don't report at all, and then the IRS actually, just their computers, I believe, are going to identify that, hey, 1099-K is filed, is reported to the IRS, yet no cryptocurrency transactions or the amounts are just so different that it can flag the IRS and create an audit risk. Now,
in your professional opinion, do you feel that the IRS is distinguishing, because you said a 1099-K, obviously I'm a business owner, I'm familiar with that. I deal with independent contractors quite often. Are they distinguishing between a crypto 1099-K as opposed to, like, for example, like you said, PayPal or, you know, Amazon or something? Are they distinguishing that, or do you think it's kind of all like under the same umbrella?
Well, I guess we'll see. We'll see how the IRS treats it. I would say that typically PayPal credit card processors, those are for businesses. So if you're operating a business, hey, you know, maybe that credit card processing, that's the top line of revenue on your profit and loss statement. That's very different than a crypto trade. So then the question is, why a 1099-K? Well, some people are using crypto much like a credit card processor to receive payment for services. And so Coinbase now has this obligation because they're acting as a payment intermediary just like a credit card processor. But your question is the IRS going to know, hey, this is Coinbase versus, you know, MasterCard or a credit card processor? I sure hope so. I think they will. But I think it's going to just create different audit flags or triggers in their computers that, hey, this person's trading on Coinbase. Maybe this isn't an amount on a P&L, But if they're on Coinbase and they get a 1099K for such a high amount, they sure should have crypto transactions on their Schedule D or somewhere on their tax return.
All right. Well, that's a kind of, I was thinking along the lines of being rational. And this is going to be a nightmare. Do you, I mean, honestly, like, do they have like the manpower to even go through this? Look at all, like, they were signing up hundreds of thousands of people a day after Thanksgiving. Like, you know, like, how can the IRS keep up with it? Like, I can't even keep up with my own trading. How can they keep up with my trading plus 100,000 a day? Like,
absolutely. And so my belief is that the IRS is going to use a couple different methods to audit or enforce the laws. And the first one being just their computer systems, and it's called automated underreporting. And the IRS does this all the time. It's where information is reported to the IRS, and it doesn't match the information on the tax returns. And their computers just spit out these notices that say, "Hey, we've got this number reported to us. You reported this number on your tax return. Explain to us why they're different. Otherwise, here's your tax bill." So I think their computers are just going to take those steps. But also, too, I think, and not to beat a dead horse here, it's why it's very important to report it on your tax returns so that it greatly minimizes your audit risk. It's also my belief that if you actually report your crypto, your risk of audit will be lower because a lot of this information is going to be reported to the IRS either way. And so by reporting it on your tax returns, even if you can't be perfect, and a lot of people say to me, "Hey, I lost records," or, "How do you compute exactly the value at this time or date?" It's not an exact science, but if you can get pretty close and use reasonable methods to get to your values, I think that will alleviate much of the audit risk or concerns that the IRS is going to have any issues with your reporting.
Wow. This is like, it's just overwhelming to me. And I'm like, and I consider myself, I mean, I'm not trying to toot my own horn, but I consider myself a pretty intelligent guy when it comes to like trading and crypto and stuff. And this is just like confusing. And I really don't see how a lot of these people are going to, obviously, handle this correctly. Especially when they just hop all over Facebook and ask, what should I buy? Like, you're asking a group of individual people that you've never met before about a financial decision. That's obviously not the smartest thing in the world. So that's what we're dealing with here in some aspects. So them treating their tax purposes, oh man, this is going to be scary, very scary.
Well, I would say there's some good news. Based on the IRS's classification of cryptocurrency as property, and also some of the things that they have yet to rule on or there's no case law regarding, there's a lot of opportunities for us still. First, by holding crypto longer than a year, having long-term capital gains, which is 15 or 20%, that's pretty darn good. For someone living inside the U.S. that made a good amount on crypto, paying 15 or 20%, you really can't beat it. And so just, an easy strategy that people can employ is just holding it for longer than a year. Another aspect that remains kind of a gray area is on whether or not LIFO or specific identification can be used to determine your cost basis. So the default that people typically use is FIFO, which is first in, first out, meaning the oldest crypto that you bought is the first one that you are going to sell. The oldest typically is also the lowest cost basis, although over the last few months, times have changed, and that's not always true. But typically, FIFO will give you the lowest cost basis. It's the oldest crypto that you bought, and it's also the longest term that you're holding it for. So again, first in, first out. But if you use LIFO, last in, first out, you take the most recent crypto that you purchased and you sell that first. Now, if you use that method, say you've got crypto that you bought 6 months ago, crypto that you bought 4 months ago, crypto that you bought a week ago. In LIFO, if you sell one Bitcoin, and that you would sell the one that you most recently bought, which may have very similar price to what the price is today, versus what the crypto that you bought 6 months ago, the price might have been much lower. So one strategy that remains something that different practitioners still view as kind of a gray area is to use LIFO, and you could greatly minimize your taxable gains. The trade-off there, though, is that often your holding period is lower because it's the last in that you're selling versus the first. So if you're trying to achieve long-term gains, that might create some difficulties there. But it really depends on each person's case.
Okay. Do you see in the future, in your professional opinion, that they are going to produce more case law about this topic? Do you see this being like something like, you know, an open discussion on how this is going to be handled, and, you know, where would this be handled? Would this be handled in like a court, or how does that work?
Yeah, that's a good question. And so comments that I often hear is, hey, the IRS hasn't released regulations on this, or there aren't explicit rules that are released. Well, to be candid, the IRS doesn't release specific rules on much of anything. They have general rules, and then depending on new facts or even different technology, that you apply the current technology to the old rules and make inferences based on that. Now, at certain times, that's tested, and the place that typically it's tested in the tax realm is in the U.S. tax court. And I do believe in the next few years, we're going to see a number of cases go to the U.S. tax court or district court, which is another option as well. And so there will be more case law that provides greater clarity on how the already existing laws or regulations should apply. For example, one area is being classified as a trader. And so being an investor versus a trader, there's actually a difference in the IRS's eyes. But there hasn't yet been a crypto trader case. In order to be classified as a trader by the IRS, you have to be dealing in securities. IRS hasn't said that crypto is a security, so can you be a trader? Who knows? Arguments can be made both ways. So, you know, that's one area that I believe there's probably going to be a tax court case in the near future.
Yeah.
So, you know, how do you get to tax court? What usually it requires is that someone is going to get audited, and they've taken a position on their tax return. And in the audit, the IRS disagrees. And so then the taxpayer will have a right to argue or contest that assessment by the IRS and take it to tax court. And so it will probably take someone standing up for themselves and fighting it to the U.S. tax court to set different case law in different areas. But I do think in the next few years, we're going to see this. The IRS has also created a special task force just for crypto enforcement. And so when we see enforcement rise, additional audits, I think that people are going to start to contest different areas as well. So we'll see how that all plays out.
Now, can I don't know how this would come into play, but obviously with the SEC and all that, there's representatives from Coinbase and, you know, GDAX, and there's a lot of legal standing there. Now, how is it that, you know, could we approach, for example, could we approach the IRS as a community through a representative and try to work this out with them? Like, for example, you know, obviously I have a lot of influence in the crypto community. Say I would raise like a donation fund and have you represent the community, not directly represent me, like actually the community. And we go to the IRS and, you know, try to hash this out and find something that like everybody can live with. Is that something that, you know, we could do in the future if that, you know, was necessary?
Sure. I mean, it's certainly possible. And really what I think that would take is some sort of lobbying initiative. And I think that's one course of action. And so I think one way is through, you know, lobbying, also talking to local representatives as well to try to change the law. I think that's one course of action, as well as people actually standing up for certain positions and fighting it to tax court. So yeah, it's certainly an option to set up a lobbying or a political action group to try to make change.
Okay. Yeah, I just want to address everybody that's watching real quick. If you do have questions, I see you asking questions. Don't think I'm ignoring you. We're going to go ahead and open this up for like a Q&A at the end, because there's a possibility we might cover your question. So if you do have a question, obviously leave it in the comments, and I'm going to go back through that at the end, but I'm not ignoring you. But man, I mean, this is just, we could probably go on for hours talking about this topic, really. Like,
yeah, we probably can, which is pretty crazy in the tax field to be talking hours upon hours about something. But it's but it's an area that is impacting a lot of people in the community, and it's an area that there's also not a lot of information or misinformation out there. And so I encourage everyone out there, ask questions. Hopefully at the end we'll be able to hit on a number of them.
See, that's what's driving me crazy, is there's no direct directions or instructions for people to follow. So obviously we're like at a new frontier here. But then again, on the other hand, that's cryptocurrency. Like, we're blazing new trails here. And when the road comes to a fork in the road, and that, we're the ones that decide to take it. I'm a huge believer, obviously, in this space. And I've said it a million times, we're in a day and age now where the guys in the business suits are coming and asking for the jobs from the guys sitting behind the desk in a hoodie. That's the best way to describe crypto. And it's just, but we definitely have to get something accomplished on this forefront in the next year or two before it actually spirals and snowball effects out of control for us. Because, you don't file this year, and next year come around, and the next year comes around, next thing you know, it's like, then it's going to be, people are going to have a real mess having to go back several years and do this on their taxes.
Yeah. And let's talk a little bit about maybe one way that the government can require some changes that will make our lives easier. So we talked a little bit about Coinbase and GDEX, Gemini issuing 1099Ks. And I also talked about how these forms, not to choose my words, but these forms are shit. They suck for individuals that are just trading. All of a sudden, the IRS is going to be shown a total number that's come in, but no information about cost basis or what the person actually paid, or if this is just coming from their wallet or what. This creates a problem. So how do we fix this? So in the securities industry, stocks brokerage, there's a form 1099B that brokerage houses, investment advisors have to file, that shows not only the proceeds, the sale, but also your cost basis. For years and years, actually, this wasn't the case. It was only within recent years that 1099Bs for stock trades were required to show cost basis. So that's recent change. But why not require the same thing for cryptocurrency exchanges? That if there was a sale on there, that you actually have to report the cost basis. Now, there's technical limitations as to why. If you transferred in from another exchange or another wallet, how would Coinbase know what your cost basis was? Well, maybe that's a problem that we should all try to solve. Or maybe Coinbase just requires if you transfer in, you type in how much you bought it for on the other exchange. Or maybe through some blockchain technology, it traces back the cost basis. I don't know, but that's an area that maybe there's an easy solution. And if the cost basis was reported, it would make all of our lives a lot easier. Tax reporting would be a lot simpler, just like it is for trading stocks. So that's one area.
Well, listen to this. And I know this is very common practice. Good thing I wasn't trading on GDEX, because it's very common practice, for example, for somebody like me. And I know a lot of fellow traders that do this. What we would do is, I used to wake up, and back when obviously Bitcoin was a lower price, the blockchain fees weren't very expensive. It cost $1 or something, $2 to send your Bitcoin. And every day when I woke up, that was part of my routine. I would literally send like hundreds of Bitcoins over from cold storage into my trading account to do my day trading. And then at the end of the day, I'd suck the account dry and put it all back in cold storage. And I kept an entire ledger of, my fund movements. And that was like part of my daily routine. But obviously I wanted to keep like nothing on an exchange, but obviously that's sometimes impossible because you have to trade. But can you imagine sending, hundreds of thousands of dollars every day in, pulling it out, and then sending it back the next morning and doing this 365 days a year? Like, GDEX would send you, a 1099K for, $40 trillion.
Yeah. And believe it or not, it's happening. People are getting 1099Ks for incredible amounts. But that's just the weakness of the reporting.
Imagine that, though. I mean, that is literally what I would do. I would wake up in the morning, I would start my coffee, and I would send my Bitcoin. And that was my trading for the day. And by the time my coffee was done, it would confirm, and I'd be ready to go for my trades.
Yeah.
And every day, when I'm done trading, whatever time that was, I'd suck the account dry. That way, if they hack the exchange, then my money's sitting in cold storage. So I could only imagine. Like I would probably send trillions, but obviously I don't have that. Like there's no way I even have close to it. Like I have nowhere near that. But I guarantee that's what that number would reflect.
Definitely, yeah. And what I also think is crazy too is in the coming years, foreign exchanges are. My belief is that foreign exchanges are going to report to the IRS as well.
You think so?
Yeah, I do. Foreign banks all across the world.
Well, FATCA, yeah.
Yeah, exactly. And, you living abroad, I'm sure you've seen the difficulty of banking for U.S. persons.
Oh, my gosh.
Banks everywhere now are basically sharing with the IRS, Department of Treasury, everything. And so, if you don't disclose your accounts file enough far in FATCA, the IRS is going to have all that information. And so I think similarly.
Yeah, I mean, I literally had a stack of FATCA forms like this I had to sign about 5 weeks ago? It was literally like this thick. Like I got this packet. I'm going, man, what is this? And every single bank account I had over $10,000, I had to fill out all these FATCA reports. And then I had to issue copies to the banks. And oh my gosh, that was a nightmare.
Yeah. So for years and years, people thought, open a Swiss bank account, a bank account in Panama, wherever you want. And the U.S. authorities will never find out about it. But they're up for a shocking reality recently with, the passage of FATCA in 2014, where banks now are sharing everything with the IRS. And I strongly believe that foreign exchanges are going to be held to the same requirement, that if they're going to do business with U.S. residents, that they're going to have to disclose information to the IRS. So, yeah, today it's just U.S. exchanges with 1099Ks. But I think in coming years, we're going to see a change, which maybe is for the better as well, because maybe that'll allow U.S. fiat into foreign exchanges too. So, maybe a good thing.
Well, that's the thing. I'm not sure if you're familiar with Bitfinex, but they obviously cut off all U.S. residents around November.
Yeah.
I think it was November 25th, I believe. Don't hold me to that date, but it was somewhere in that range that they literally, they said, you're a U.S. resident, we're not going to do business with you anymore. And I have a feeling that obviously they don't have a problem with the people. They're not trust me, they would take their money in a heartbeat on exchange fees. They're making millions a day off of exchange fees. It's not the people they have a problem with, the traders. It's, obviously they just don't want to be held under that, microscope by the U.S. government and, have to abide by all that because it costs them a ton of money. And I'm sure in legal fees, that has to add up quick for an exchange to represent themselves, to the SEC and all that. Imagine what would you charge to fly to every single SEC conference and meeting and, have to do all that. It would cost them a fortune. You would literally have to be full-time for that exchange. That lawyer represents that exchange and retained and done.
Yeah, but hey, it may be worth it. I mean, for some exchanges, think about the amount of business that they're losing. Think about the size of Coinbase, Gemini, GDEX, Kraken in the U.S. exchanges. I mean, there's very little competition.
But then again, I mean, you also got to look at it look at JPY. JPY BTC is one of the biggest, largest trading volume pairs there are. Yep. And I have a feeling that a lot of these exchanges are going to switch over to euro. Like we're going to stop using the dollar soon. And I'm already seeing it come. Like they're already introducing euro pairs and JPY pairs on the normal USD exchanges.
I think it was in the news in the last couple of days. Binance supposedly moving to Malta.
Yeah, they're in Malta now.
Yeah, EU country. So my guess is that they'll have a euro trading pair. Also, my belief is that they're going to have access to banking in Malta, so it makes sense that they'll be clearing in euro.
Yeah, they're probably going to start with Euro T, like Euro Tether, and I think that was one of the reasons that was created, because Tether Euro is obviously maybe 4 months old, I'd say. It's pretty, it's still in its infancy, and there's not that many. There's only like maybe $1 billion worth of it, so it's really not that much. But obviously, like we're starting to see the trend, overall lean away from the dollar, and it's kind of like the U.S. is just like sticking their foot in their mouth, consistently, like all the stuff with the Chinese now through, and they're basically selling steel to us, below cost, and they're just like they're pissing in everybody's front door and expecting them to walk through it every day. And that's not really a good thing. So I wonder how long they can keep it up. But yeah, obviously Binance, I'm going to try to go ahead and contact them and get a live show with them eventually. I sent them a message on Twitter, but obviously he's busy. Yeah. Let's see what he says. But that would be pretty cool. And discuss the new moves. You got anything else you want to cover before we start going through some of these questions? Or, obviously we've been just gabbing away. What's up?
Questions.
All right. Oh, man, let me scroll back through this list, everybody. If you got questions, now is your time. Chance. Sorry if I get quiet for a minute. Going to meetings or something. I don't really see many. You see any questions? You want to start reading through them too? It says, how is the IRS going to reconcile the 1099 versus the reported gains?
So it's a good question, and unfortunately I don't have a good answer. So the problem is because the 1099K, like I talked about, shows the total amount going in when that's not representative even of your total sale proceeds. So, as you talked about, Todd, if you had money from another wallet, goes in and out of Coinbase, your 1099K number could be very huge. And that's not even just your sales, that's just totals in. So how's IRS going to reconcile it? I don't know. And it's very possible that they're not going to at all, but instead they're going to use this as a trigger or flag that, hey, this person has crypto activity. And so then if there's no crypto reported anywhere else on their tax return, it's a flag for audit or further follow-up because, hey, Coinbase shows a bunch of activity, nothing else. Now, are they going to look for the exact number to reconcile out? I doubt it. I don't think it's possible. But like I said, I think it's just going to be used as a trigger.
Okay. Next question from Jordan was, when do gains become realized? If a trade from BTC to US dollar, but don't withdraw said gains from my exchange account, is that considered realized?
Yes. Yes. So
I can answer
yes.
that.
Yes. Whenever you go crypto to anything, and when I say crypto, I don't even just mean crypto generally. Like you go from Bitcoin to anything else, even if it's another crypto, that's taxable. But if you go Bitcoin to USD, keep that USD in your USD wallet in Coinbase or whatever it may be, still taxable, still a gain.
Yeah, I could answer that.
Let me take it a step further too, because this is another question that comes up too. Say you formed an LLC and you did the trade through the LLC, still taxable to you even if you left that money in the LLC's bank account. So you sold the USD, kept it in the LLC's bank account, still taxable to you, still taxable at the same rates. So putting it through a business doesn't, or specifically an LLC, doesn't do anything different.
Now, what about an offshore company? Like, saying you want to go over to like St. Nevis or St. Kitts and open an offshore.
Sure.
Would that make a difference?
And that's a question that comes up a lot too. And it depends on the person's tax residency. If you are living in the U.S. and you form a Nevis trading corporation and conduct all the trades through your Nevis Corp, but you live in New York, you're still going to be taxed in the U.S. The IRS has passed, or the tax code has been updated decades ago to get rid of all those loopholes that allow you to basically defer passive income. And so if you're just living in the US but running everything through a foreign company, you're still going to be taxed. But if you live, say you live on an island of your choosing, or say you live in Colombia, but you set up a trading corporation in Colombia, then that's different. Because now you're a tax, you can be a tax resident of a foreign country, and it's not a passive foreign company. You're actively participating in it from that foreign country. So you, in those types of cases, that's different. So then you can defer your earnings by holding it in a foreign corporation. But the key there is that you have to live abroad. However, and I don't know if you're aware of this yet, Todd, but the 2017 Tax Cuts and Jobs Act changed a lot of the deferral rules. And so now there are some requirements now to repatriate or distribute the earnings. And so things have changed, but generally speaking, you've got to live abroad in order to benefit from a foreign corporation. Otherwise, you're wasting money.
That's pretty smart. I would have never thought of that. I would have never thought of that one. Yeah. What about your foreign income tax credits? Man.
Yeah. So
the moral of the story is get out of the U.S., get a bank account out of the U.S., and mail them the passport back. Say, I don't want this anymore. That's the moral to the story here.
Well, you don't have to go that far. You don't have to get rid of your citizenship, but there's two good strategies if you're willing to be a nomad. One is live anywhere and work from that foreign country and set up a foreign corporation. And there's significant tax savings by doing that. And in general, in order to qualify for what's called the foreign earned income exclusion, which knocks out about $100K of your income tax-free.
It's $92,300.
There you go, about $100K.
I heard.
You also have get a housing deduction as well. So there's some other ways to increase it past that 92,000 or so. So that's one way. And so you got to live outside generally 330 days of the year in order to qualify for that. Another option, which I believe is the best option for U.S. persons, is to live in Puerto Rico. In Puerto Rico, there's either a 0% or 4% tax on your income. You still keep your U.S. citizenship, and in order to qualify for that, you've got to live outside, or you have to live in Puerto Rico at least half of the year. So not 330 days. Now, we've had a number of clients that have moved there even after the hurricane. You only have to live there half the year, and you could essentially pay 0 or 4%. 4% is less than some states' income tax.
Well, I'm not sure if you're aware of this, but the real trick is go ahead and get residency in 2 South American countries, because 98% of these countries here say if you're not in the country 183 days, you're not a taxable resident, but you're still a resident. So therefore, what you do is say you stay in Panama for 180 days, and then you fly down to Chile, stay there for 180 days, and then go sit in the islands for a week on a vacation in the middle, and you keep rotating around in a circle, and you'll never pay taxes in there. And it's perfectly legal because you're not a taxable resident, but you still own a residency status, and you're still out of the U.S. for your 15 days. You're only allowed 15 days in the U.S. for the foreign income tax credit. I don't think it's 330. I think it's like 345 or something, 340. But
you can double check me and we could post the answer later on. But I'll put my money on 330 days of the year. So we'll see, man. Yeah,
I thought you were only that gives you 25 days in the country then. 35,
I think. 365 days in the year.
Yeah.
Either way, you got to be outside the country. for the majority of the time. Unless you live in Puerto Rico, then that's only half the year. So, yeah, different options there.
Well, at least talking to you makes me feel better. At least I did everything correctly without much. Well, I did it right without like a lot of legal advice. Like I figured this out on my own.
Yeah.
So you know, that worked out pretty well for me because a lot of this was, you know, pre-crypto, the moves I made. So, you know, that worked out pretty well. I actually did it like correctly. So that's pretty cool. Let's see. Let's find another question. It says, if you trade on leverage, you pay interest to use the leverage. Can you write that interest off? I'm probably can answer that absolutely yes, but let's hear Andrew's response.
Yes. So if you pay interest, yeah, you can. And so a couple different ways potentially to deduct it, either as an interest expense on Schedule A or as a cost of your sale, or, you know, whatever. Whenever you then go to sell or make profits off your leverage, it's a deduction against those profits. So yeah, one way or another, you can take a deduction for it.
Okay. Here's my question. I think I asked you this before. What if I would only short the market? Because technically I'm selling an asset at a higher price and buying it back at a cheaper price.
Yeah. So, I mean, right. And so usually that you're going to have, you know, a payout, or you're going to net a gain on that, assuming that your short was successful. And so whatever that gain is, that would just be a short-term gain. So we're not tracking necessarily cost basis there versus your sales price. It's just, you know, if on your short you get paid out of whatever it is, a Bitcoin or whatever it is, that's now a short-term gain.
Okay. All right. Let's see. Next question. Would a U.S. Beneficial owner of an overseas trust that owns an overseas trading entity mean something? Oh, PFIC applies rather than 5471. You understand that? That's Greek to me.
I do. Reach out to me, whoever asked that question. That's a very specific.
That's Jordan Bastista.
Yeah, advanced question. I'm happy to talk about that, but probably too advanced for this one, this chat.
I got you. Okay. You know, you heard that, Jordan. Obviously get in touch with Gordon, and you know, he'll clarify that for you. Says maybe I shouldn't have asked as the U.S. What else questions we got? Does Bittrex report to the IRS? Personally, I haven't seen any forms yet, but have you, Andrew?
I haven't seen it yet, not that I'm aware of, but doesn't mean that it's not happening or will happen soon. So I'm not aware of it.
Okay. What are the tax implications related to coins that provide dividends?
Sure. So, and this similar question for hard forks or airdrops. There's two different opinions or schools of thought for hard forks or airdrops. One is that it's just zero cost basis, and when you eventually sell it, then you recover the entire, whatever that total sales amount, that's all gain. That's one school of thought, and I don't agree with that. Instead, the other approach is that it's income at the time that you received it. You pay taxes or owe taxes on the fair market value at the time you receive it, and that amount now becomes your cost basis. So, for example, Bitcoin Cash fork, I believe it was August, roughly $300. Say you had 2 Bitcoin Cash that then arrives in your Coinbase wallet. Our suggested tax treatment there is that would be income at the price of, I think it was roughly $330 per Bitcoin Cash at the date that the fork happened. So we would report ordinary income of that amount, but now that's your cost basis. So when you sell it, say you sell it right away, and sell it at $330, that $330 is your total gain. It's not taxed again because your cost basis is $330, sale price is $330, so zero gain. You just pay the tax that one time. So that would be We suggest treating it that way. And that also follows kind of the IRS's pattern of how the IRS deals with the receipt of treasure or lottery winnings. There's been cases, for example, you dig up gold in your backyard. Even if you didn't want that gold, you didn't ask for it, you just found it while digging for a pool in your backyard. That would be income to you. And so similarly with a fork, the receipt of Bitcoin Cash or Bitcoin Gold, we also believe that should be taxed as income at the time you receive it.
Well, as far as I'm concerned, that was a gift. But but how about, for example, there is so many forks and I have so many wallets that I haven't even wasted my time trying to like claim all these. So do they like still say that I consider I have them, even though I haven't in a sense, like I'm still kind of technically in possession of them because I'm in possession of the private keys, but I technically haven't taken possession of them either because they're not actually in a wallet.
Yeah, that's a tough one. And we feel that certain airdrops or forks that are in your wallet, you've got possession of them. That's quite clear. But what about all these, 100 airdrops of all the miscellaneous tokens that you don't really want or care about? Those, we feel comfortable that you haven't actually taken possession of them, or you take the position that you've abandoned them. So even though you've got them, you're abandoning them. And so basically, even if they're in a wallet, if you could get rid of the key, you'd get rid of the key. But here we're constructively abandoning them. So certain small ones I wouldn't report, but certainly, for example, if you got Coinbase and you've got Bitcoin Cash all of a sudden in your wallet, you can sell it. Even if you don't want that Bitcoin Cash, I would argue that is income and should be reported.
Yeah, because I mean, I literally get so many shit coins airdropped to my Ethereum wallet, it's not even funny. And I don't know how many countless times I literally burn those tokens. I just send them to a burn address to like clear out my wallet, because if you look at my Ethereum wallet, my cold storage, I have a list of like this long of just like shit.
Yeah, and burning them, sending them to a burn wallet, I would say is doing exactly that, and abandoning it. So you're basically saying, I don't want these, and we could take the position of the IRS, I think very reasonably so, that you've abandoned them, you've gotten rid of them. So it shouldn't be included in income.
Well, I did that correctly too then. All right, I'm just like taking some mental notes here to like make sure I'm doing everything correctly. Because obviously I don't want these fools breathing down my back being a business owner. I'm trying to keep up and do the right thing, but they're kind of making it difficult on me. So, man, now we got to worry about burn tokens too. Oh my gosh, this list just getting long and long and long. All right, next question. Let's see, what do we got here? Can we contact you as I'm from India? I'm sure Andrew's open for anybody to contact him, whether it would benefit you or not. I don't really see him, practicing law in India, but.
No, we've got clients all over the world, but we practice U.S. law, U.S. tax law. So if you're from India and you've got questions about U.S. tax, we'll certainly help you. But if it's about Indian tax, probably not much about it.
It says, can I invest crypto under a business entity versus an individual trader so that I can claim tax deductions? I think you covered that, didn't you?
Yeah, so just by forming a business entity, that doesn't allow you to have any different tax treatment or allow you to take deductions any differently than if you were just investing yourself. But there's a difference between being a trader and an investor for tax purposes. Most people, they call themselves traders, but in the eyes of the IRS, they're actually an investor. The difference between a trader and an investor is that traders, they're doing this for a living. They're trading every day. The IRS and the tax court examples of traders, they're literally making trades, executing trades every day. There's different discussion as to how many trades you need a day. Also, it's typically your only occupation, so all that you're doing for a living, although it is possible to have other sources of income as well. So why does this matter? Why would someone want to be classified as a trader versus an investor for IRS purposes. It's because as a trader, you can deduct any expenses directly as an expense versus an itemized deduction. So traders, you've got expenses for your computers or research, home office, all of that. You can directly deduct that. As an investor, you can't. You can take an investment expense for certain things, but those are on an Schedule A itemized deductions, and so you get less of a deduction there. So as a trader, you get to basically write it off directly. Also, traders can file something called a mark-to-market election. And so, you talked about, Todd, earlier how it's a crazy pain in the ass if you're trading every day that you got to keep records of everything and report all that and pay taxes. You can file a mark-to-market election, which basically looks at your portfolio value on January 1st. Then on December 31st, looks at the value again. Whatever the gain or loss is on portfolio value, that's your taxable income or loss. You pay tax on that versus each individual trade. And you can only do that and file that election if you're classified as a trader. Let me take this one more step. As a trader, you may also be eligible for a 20% deduction. This was a deduction that was passed in the recent Tax Cuts and Jobs Act. And so as a trader, there's a 20% pass-through deduction on your activity. However, if your income is over a certain amount, it actually gets eliminated or phased out. So it is possible as a trader, not as an investor, to get an additional deduction too. So there's a couple benefits, but as a general rule of thumb, it's very difficult to be classified as a trader versus an investor.
Okay. All right. Well, so that actually just put a little bit of knowledge in my head and some thought. So that's why the market was correcting right before those dates.
It's possible. Also,
they were balanced. They were balancing out their accounts, probably more than likely.
Two, one thing just in terms of tax strategy, if you are selling, on December 31st, if you want, say you've got a number of gains throughout the year, but then you've got losses, but you haven't realized them because you haven't sold. Well, some people then sell on December 31st or exchange for other cryptos to realize those gains, realize those losses, and apply those towards the other gains. So as a tax strategy, some people start to sell December 31st. Now, because there's no wash sale rules, and I can talk about what that means, then people could buy again. You could buy again January 1st, and now you've got a new cost basis. And now if you're doing FIFO or whatever, however your inventory system, it's just like a new purchase. So you could sell on December 31st, buy on January 1st, and it's in different tax years.
Yeah, well, I don't, because I wouldn't think that would be considered wash trading, though. Wash trading would be selling into your own order at the same time and date. So,
well, and there's actually most practitioners I've spoken to don't believe that wash trading rules apply to crypto. So even if it was under wash rules, many people don't feel that crypto applies. But that too is an area that maybe there's going to be clarification either by the IRS directly or through tax court in coming years.
Okay. Well, yeah, I mean, I hear the argument all the time that wash trading isn't, applied to crypto. But honestly, I haven't read that law or whatever. What's the name of that again? It starts with a C, I believe, that act.
For wash trades, I'm not sure.
Yeah, I can't remember it off the top of my head. It starts with a C, something. It was just a couple of years ago they developed it. All right, let's look at the next one. Is there any way to defer your taxes on crypto? Hypothetically, of course.
I mean, there's a couple ways, but unfortunately, none of them are easy or applicable to most people. So certainly living offshore and forming a foreign corporation, that's one of the most obvious ways, but unfortunately very difficult. You got to live offshore and have a foreign corporation. Otherwise, the trigger to taxable activities are sales or exchanges or purchases, or any sort of change in the crypto. So instead, a loan against the crypto is not a taxable event. So if you collateralize a loan with your crypto, it's not a sale of your crypto. And so, that's one strategy that you could employ. And there's certain different projects out there, for example, crypto-based lending, where you could collateralize your crypto. So say, you're 2 months away from long-term gains on your Ethereum. Well, if you take a loan against it for 2 months instead, you could then benefit from potentially half of the tax by having a long-term tax rate.
Okay. Can we touch on the subject of taxes as far as mining? Would that be considered, you would take the position, obviously, as an airdrop or, a fork? Would that
Sure.
be a fair enough statement, or you want to address that?
Yeah, so mining is actually like running a business, and it's income to you every time you receive mining proceeds. So, if you're paid out every day or every week as part of a mining pool, whatever that may be, it's income to you at the time of receipt, not when you convert it to cash. So you get paid out a Bitcoin in 1 week, then you have a taxable event at whatever the fair market value of that Bitcoin is the time you received it. Even though, again, you didn't convert to fiat. Now, any expenses related to that mining are directly deductible. So I talked about how if you're an investor, expenses aren't directly deductible, only as a trader, as crazy as that distinction may sound. But as a miner, you're running a business. And for many people, it makes sense to form an LLC or an S Corp or an entity for their mining operation. It really is a business. So any home office, rent for, your wherever your mining space is, all of these are expenses and deductions against your income. Now, when you then receive that crypto as payouts from mining, then sell it again, now there's also the potential that you have another gain or loss depending on the value that you sell it for. So say you receive Ethereum, 1 Ethereum today as a payout, and say it's $500 today, and 2 days later you sell it and it's 600. Well, you have the $500 of income today, and then when you sell it, an additional $100 gain as well. Both of these would be taxable events. Total tax of $600 on $600.
So by
you
saying that, treating it as a business, then would it be beneficial to actually start an LLC for a mining company, or not? Like, I'm using the word company, but for an individual sole proprietor to form themselves as a company if they're, somewhat serious about mining?
Yes. If you're mining, yes, I think it does make sense. Now, an LLC versus just running it as yourself may not directly have a tax difference. They're both taxed as pass-throughs and are both on your personal return. But as just a matter of practicality as well, by having an actual business, having a business bank account, business credit card, running all the expenses through that, people often tend to track more of their expenses better when they actually have a business credit card that they could run it through. And in some cases, having an S Corp does have tax benefits. So, it depends on your levels of income, but there may be benefits to having an S Corp as well. So, yes, in most circumstances, I would say form an entity, have a discussion with us or an attorney about which entity makes most sense for you. But yeah, in terms of bang for the buck, it's a good course of action.
Okay. All right. Well, that makes a lot of sense. I figured it would be something along those lines. All right. Let's see. It says, since crypto is taxed as property, are there any sales or property tax implications on the top of the capital gains? That makes sense?
No.
So I guess the answer is no then to that one.
Wait, what was the question? I'm trying to read it.
Okay, I'll read it to you. It says, since crypto is taxed as property, are there any sales or property tax implications on top of the capital gains? Oh, I understand what they're saying.
I think he's saying I think so. I think he's asking like a sales tax, or property tax on it. Good question, actually. That's a new question for me. I would say probably not, because sales taxes generally apply if you're selling products. So say you opened a crypto store and people can go in and buy crypto, then maybe sales tax would be applicable, but that's generally what's not really going on here, and you've got other legal concerns too. Short answer, sales tax and property tax, not applicable as far as I've seen to crypto transactions.
Okay. All right, we'll cover that question. Next question from Brad. If you buy and hold for a year, you only pay capital gains. If you trade but leave your money on the exchange for a year, you can't claim it as capital gains? Makes sense?
Not really, but I'll try. So yeah, I mean, if you hold crypto for over a year, then it's a long-term capital gain versus short-term.
Oh, I understand what he's saying. You want me to rephrase that?
Yeah, can
he's basically saying, all right, I buy Bitcoin today on March 25th. Say I sell it on May 5th, but I leave that money on the exchange until January 1st of next year. Then I withdraw it to my bank account.
Yeah, good try. You're right. You deciphered that well, Todd. So that would be a good attempt at obtaining long-term gains, but no, unfortunately, the trigger of the sales date is when you actually sold, not when you took the amount out of the exchange. So you sell it today and left the money in the exchange. It's still as if you sold it today, still short-term. The leaving of currency on the exchange is not a taxable event, has no taxable difference if you pull all the money out or leave it on exchange. Also, no taxable difference if you move it to a different wallet or between wallets. That's similar to like moving money between your own personal bank account. Not taxable, no difference there.
Yeah, it makes sense. I had to think about that for a second myself. I see what he's saying.
I get it too.
It's a good one because he was, I guess, coming with the approach, well, I didn't technically take possession of it. Exchange had it. So it's not technically in my wallet, it's in the exchange's wallet.
Yep. No, it makes sense.
Yeah, I understand it now that I thought about it. Let's see, I'm reading these. James Green said, I feel like most of my posts on CCT created a stir in taxes and crypto. He's telling you, thanks, Andrew, for pointing out the errors on my paper today. Going to see. All right, he says, let's suppose that we are running a node to protect our wallet and mining to help with the safety of the network. Is the miner and the node hardware tax deductible?
So any costs of mining, again, mining is a business. It's different than investing in that it is actually a business, and so any expenses are deductible. So mining rig itself, any other expenses directly related to the mining are deductible. So electricity, say you got to have a security system, that's deductible. Say you need other software or other hardware components, all deductible. Now, depending on the type of asset, you may not be able to deduct it all in the first year, but there's a number of different rules as to that. And in most cases, you could deduct most of it in the first year. But yes, any expenses directly related to the mining is deductible.
Okay. I think I got all the questions here. The miner knew that, yeah, I answered that one. No, I mean, we have some good questions here. You covered a lot of good stuff. I definitely learned something. I got to admit that. Thanks.
No problem.
Yeah. I feel like I like doing stuff like this because I feel like I got something accomplished and I learned something. Yeah, what about, oh, that was one. I had the guy the other day or whatever. Listen to this story. This guy, and I think this is what he's doing. He's a preacher, and he also runs like an investment company. I think he's running all that stuff tax free. Is that a workaround?
So
like doing it through like a church? I know it sounds funny, but I'm literally like not joking. Like it's gotten really like I really think that's what he's trying to do.
Okay. So it's possible to have a nonprofit in the crypto industry. And actually, I've had a number of discussions with people, and even some Facebook groups. It may even make sense to create a nonprofit. And by doing so, if people donated to it, that would be a tax deduction for them. And the income into the nonprofit is not taxable to the nonprofit. That being said, if the nonprofit needs a charitable purpose. So, for example, say you create one that's teaching about blockchain and crypto throughout the world, all right, or something along those lines. That's fine. But if then it starts to trade or have crypto, other unrelated income, that may disrupt the the charitable purpose and may be taxable. So if it's unrelated income, such as like trading or mining, but you're running a charity teaching about blockchain to underserved communities or something along those lines, then you're going to blow the non-tax status, and it's still going to be taxed. So that's not going to really work. But I think someone even posted here, well, what about a nonprofit lobby group? If it's possible to create political action type things and nonprofits in that sphere, in which there might be deductions and so forth. But if you're really just mining or running trading through a nonprofit, that's not going to fly.
Well, that makes sense. Everybody's always trying to figure something to work around. But hey, I don't blame them, man. Brainstorming, because this is such a broad topic, I guess you would say. I wish they would just clarify it and get it done with, I mean, yeah, you take the approach that they did, but I still kind of feel like they didn't, but I guess it is what it is. Maybe one day we'll get something better out of them. All right, everybody, is there any more questions? Would the nonprofit pay capital gains if the crypto it received goes up in value?
So it depends if it's receiving this crypto as a donation, or if it's trading. And so if it's trading and it's got this crypto, then likely it's going to be taxed. And I actually believe that nonprofits are taxed at a higher rate when it's unrelated income that they receive. I have to double check that, but they would certainly be taxed potentially at a higher rate. And so generally not a good idea to have any sort of trading activity through the nonprofit. Now, if it received a donation and then that donation went up in value and it sold it, that would be a different question. And in that case, I'd have to verify the answer, but I believe that it may still be possible to not be taxed at all, even on that appreciation of value on the donated property. And I think we can even see similarly, like say a charity got, a donation of, an autographed memorabilia, and it sat on that for a year, and then it went up in value. It still generally wouldn't be taxable to the charity. So I think we could see analogies there too.
All right. Yeah. Well, that would make sense. I really don't, I don't know. I don't think it would make sense. I just kind of like go with my gut feeling on what makes sense here. Yeah. And obviously, I'm not the CPA or the lawyer, but I did pretty well, man. I'm actually kind of happy I had this discussion with you. Like, I did it right. Yeah. I don't have to. And now the good thing is I feel like I don't have to worry, because I kept even though I tried to do it right, I kept feeling worried that I didn't do it right, if that makes any sense. So I kind of had that cloud hanging over my shoulders and head. But you pretty much clarified that I did it right. So I kind of feel better now. Oh, that worked out good. Let's see. Would you still be required to file your taxes if you didn't receive a 1099-K from the Coinbase? Yeah.
Yeah. So
yeah. I'm not even the accountant here, and I can tell you that one.
Right. So even if it's not reported by an exchange, you still have an obligation. Even if you only traded in Monero or some privacy coin, or only on decentralized exchanges, or whatever fact pattern you can come up with, as a U.S. taxpayer, as a U.S. person, you still have an obligation to self-report. So it doesn't matter that it wasn't reported on a 1099-K.
Yeah, I mean, I'm not really here to give financial advice, man, but I'm advising everybody, listen, just go pay something on your taxes, because if you don't and they get that, they're literally, you know, you have a chance a year or two from now that that's coming back to haunt you. So, you know, whether you pay the full amount, you know, that's on you, but I'd pay something. You know, that's probably your best bet. You know, you don't want this type of thing, you know, come haunt you in the future. So, you know, that's the last thing you want. That, like, because I really see it coming to the point where, you know, 2 or 3 years from now, if you owe taxes on crypto and they come in and start seizing GDAX accounts and freezing your accounts like they would, you know, a levy for a bank account. I really see that, you know, possibly coming, especially with their New York licensing and all that. You know, I see that coming down the pipe, man. Like, you know, they're going to levy your, you know, GDAX account. Well, do you feel that's a fair and accurate statement that you know, a possibility?
Well, you know, I think what we're going to see is that exchange accounts, online wallets, those types of things are going to be treated and regulated much like banks. And like I talked about earlier, even foreign exchanges, I think those are going to be regulated like foreign banks. So, you know, is the IRS going to be able to levy them if you don't report or if you owe money? Well, the IRS can levy other property, you know, a bunch of paintings or other assets, but you owe the IRS money, they can come in and take them. So, you know, I think crypto or your wallet is going to be an asset just like any other that's going to be within the IRS's grasp.
Huh. Yeah, I definitely think that they're going to start levying stuff, and I don't see it happening this year, or maybe not even next year, but it's coming. Like, it's coming. Like,
yeah.
are just, you know, they're not going to leave it alone. Like, you owe money, they're going to want it. Next question. The tax advice deductible for running a minor. He says, is tax advice deductible if we're running a minor? Yeah, it's an expense. If you pay a CPA or, you know, a lawyer for, you know, a retainer or something, of course you write that off. It says, this might be a vague, but are there any good ways to decrease your taxes that have not been covered in this live video that you would suggest?
Some of the best ones are analyzing FIFO versus LIFO. And we typically, you know, do that at year end across all the transactions. A question that I did see come up in here is if you can do FIFO and LIFO per exchange or wallet or across all holdings. LIFO itself, again, is a gray area, and actually under the tax code, it falls under what's called specific identification rather than LIFO. But, you know, we do feel that strong arguments can be made that LIFO or specific identification is applicable to crypto. And so if that argument is accepted, then it also can follow that LIFO can be applied per exchange or per wallet. But it makes record keeping much more difficult because you should remain consistent going forward as well. So, you know, if you're doing different methods on different wallets and then moving across exchanges, it may become very difficult from a record keeping perspective. But one good strategy is doing a FIFO versus LIFO analysis. Another good strategy that I would suggest is having an accountant or a tax attorney prepare for you a closing year-end closing report so that you know what your holding period is for all the crypto that you hold. And that can help frame your decision making as to when to sell your crypto. If you don't know exactly what your holding period is and you just sell based on the market, you may give up long-term gains by, you know, just holding a couple more days or waiting to a certain period. So knowing your holding period on your crypto is also a good strategy as well. For some people, the trader election does make sense. So if you are trading every day, have a discussion with us or a tax attorney about whether or not you can be designated to be a trader, because the 20% income deduction that applies for traders is an incredible deduction. So if you can apply and be qualified, it's a great way to go. Can't hear you, Todd. I don't know if you can hear me, but I can't hear you, Todd. I think you're muted. Still can't hear you, Todd. All right, well, I don't think we can hear Todd. So I'm going to see if there's any other questions. One question that I see here is about losses. So say you lose your private key and you can't get access to your wallet. There are a couple different ways that you could take a deduction for that. Part of it depends on what year the loss was incurred, because under the 2017 Tax Cuts and Jobs Act, again, there were some changes in the tax code which made it more difficult to claim what's called casualty losses in 2018 forward, which requires that 2018 forward a loss be as a result of a natural disaster. So if you lost your private key because a hurricane struck your house or a tornado sucked up your private key, you may still qualify as a casualty loss in 2018 forward. If it was 2017 or earlier, the rules are broader than just natural disasters, but it still needs to fit under certain other rules in order to be claimed as a casualty loss. But another option that's available is that you basically record the sale of the crypto at a price of zero, that it's worthless because you can't get access to it. So if you lose access to a private key or a wallet, there may be an opportunity to basically sell it at a zero price, which would generate a loss for you, and you can offset other gains with that loss. So talk to your accountant or tax attorney about losses of a wallet, hacks, hacks to your individual wallet, hacks to exchanges, things like that. There is a potential for deduction.
All right. Can you hear me now?
I can hear you, Todd. Welcome back.
All right, cool. I think my AirPods died. So, all right. Yeah, I caught most of that. Let's see. Do you have contact info? Because I still need to file my taxes. Yes, I'm going to go ahead and obviously I'll let him say that at the end of the video. But I'm going to go ahead and put that in the comment section of the video once it uploads to YouTube. So refer back to that, you know, after the video, and all his information will be there, websites, internet, all that good stuff, if you want to reach him directly. Let's see. Let's say you lose all your money on Bitfinex by getting liquidated on a margin trade. In this case, would you still have obligations to file? Yes.
You're learning, Todd. You just do my job soon.
I mean, I've been doing it. I did it right. Like I'm kind of happy about that. No, I can answer a lot of these questions because a lot of them we covered before on the last video. So.
And the reason that you'd still want to report it and file and show all the trading activity, even if, say, at the last day you had a loss and lose all your money, is the IRS may say they get a 1099-K that shows all this trading activity. You don't report anything because you say, oh, at the end of the day, I lost money. There's nothing to report. You may just be asking for an audit. Also, you have an obligation to report each transaction, each sale, even if it's a gain or a loss. So you'd have to show all the gains throughout the year and then the loss at the end to overall knock out that gain. But yes, you do have to still report.
Gotcha. Yeah. All right. If you partake, no, hold on. If you made money throughout the year and lost everything, all right, that's what we just did. I think that's all the questions.
Yeah, I think we hit them.
Yeah, cool.
Over a lot today.
Yeah, we did. How long have we been on? It's 9:45. We've been on like an hour and a half. Yeah. Hey man, I mean, no, we got a lot covered tonight. That was great. And the good thing about this is now it's documented on the YouTube channel. So we can always refer and share that video. Somebody ask a question or whatnot, just say, here, go watch this. And if you need further clarification, then obviously contact him. You want your taxes done, contact him, blah, 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 you know, and it's documented. So I think we got a winner here. Is there any last questions? Because it is getting kind of late for me here. Obviously, I got to get up at 5 a.m. because U.S. market open. So I want to at least get like, 3-4 hours of sleep tonight. If you had gains in December but lost a bunch in January, then what? Well, then obviously that's on this year's taxes and that's on last year's.
Yeah, you're absolutely right. It sucks, but actually given the market, it's very possible that you've got some big gains in December and then losses now. But yeah, separate tax years.
Yeah. All right. Well, let's go ahead and wrap this up. Andrew, I definitely appreciate this. I'm sure the community appreciates this. It was a great wealth of knowledge and always a pleasure speaking with you. Obviously, this is our second video. Now we got some things documented. Is there any final thoughts? And obviously, give your information out. I don't, expect you to not do that.
well, thank you again for having me. Great as always, and wonderful community, both on YouTube and Facebook. So it's great chatting with everyone and great questions. If anyone does have any additional questions, or if you want us to prepare your tax returns or advise on other crypto or legal matters, happy to help. I could be contacted on our website, cryptotaxhq.com, cryptotaxhq.com. Our Twitter, @accounting, believe it or not, @accounting is our Twitter, or our phone number is 847-580-1279. Feel free to contact us through any of those channels, and be happy to chat.
Yeah, just one last time. Of course, also you can refer back to the YouTube video. I'm going to go ahead and upload all that in the comments section. So if you didn't catch that or whatnot, it'll be a quick reference for you, or get in contact with me. I have all his contact information already. So let's go ahead and wrap this up. Thank you very much, Andrew. I'll get this uploaded, get your information on there, and let's get some sleep. It's getting late.
All right.
All right. Thanks, everybody, for tuning in. Good night.